But we're here now. So thank you, Richard. Thank you, Stephen, for joining us once again. So let me introduce the broadcast now that we have you both here. So once again, my name is Carlos Leon. I work as Director of Financial Market Infrastructures at Digital Currency Solutions at FNA. I'm your usual host and moderator of the FMI Broadcast. So some housekeeping and introductions first. You can go to the next slide. So as we have lost a little bit of time, I'm going to very briefly say that FNA is a leader in advanced network analytics and communication. Most of our solutions try to deal with large complex data sets to try to predict the impact of stress events and to optimally configure financial systems and financial market infrastructures. And as you can see in the logos that we have at the right, we have many clients among the largest central banks, government authorities, commercial banks, and financial market infrastructures around the world. Next slide. And about FMIs, something that I want to share very briefly is that FNA works all around the FMI life cycle. And the FMI life cycle has to do with the design, the validation, the go live within the building phase of an FMI project, and also in the operation and or operating and overseeing phase of FMIs, which includes the monitoring, the stress testing, and optimization of the operations of the financial market infrastructures projects. So let's go to the next slide and let's start today. So once again, we have Richard Dzina and Stephen Wojciechowicz. I hope I said it.
That was probably better than I could say.
And it was better than the last time, because last time it was really very painful. So last time we shared the floor with Richard and Stephen. That was some months ago. It was broadcast number 6, and it was so good. And we had so many nice comments from our audience that we said, well, we had to do it again with a little bit of with a twist about the topic, and and we're going to deal with something which is like in the intersection of the broadcast, the two broadcasts that I host and lead, which is the CBDC broadcast and the FMI broadcast that we have today. So our guest speakers, Richard Dzina, he's Senior Vice President at the Clearing House. He joined the Clearing House in 2020 following a 28-year career in the Federal Reserve Bank of New York. He has the product responsibility for the Clearing House Interbank Payment System, which is the largest private sector USD clearing and settlement platform in the world. Thank you, Richard, for joining in. Again, and we have Stephen, let's leave it like that. Stephen is responsible for the development and delivery of USD clearing services. He's Chairman Emeritus of the BAFT Payment Committee and a former Dean of the Payments Institute and he is the Senior Principal Product Management at BNY Mellon. So again, Stephen and Richard, thank you very much for joining us. We're going to have a very nice conversation about, as I mentioned, the intersection of two hot topics, which is liquidity management and CBDCs, focused on, obviously, wholesale CBDCs, which is like the more appropriate topic for the FMI broadcast. So that's the main topic. And as a form of intro, I would like to say that obviously the FMI broadcast is about the market plumbing. I mean, the clearing, the settlement, the payments, and the custodial systems that underpin markets and commerce at the end. So when we start hearing about wholesale CBDCs, we have to think about what are wholesale CBDCs going to bring to the FMI, to the financial market infrastructures, to the settlement of transactions. That's the main topic that we want to touch today, and to try to understand whether the wholesale CBDCs are going to change anything at all. And if they're going to change, because I presume there are some things that will change, what are the challenges, what are the benefits, and what things can we foresee that are going to happen in the FMI space? So that's the reason why we have Richard and Stephen today. So let's start. If each one of you can give us a very brief introduction and overview of your respective institutions' approach and perspectives on liquidity management and wholesale CBDCs. let's start with Stephen.
Sure. So I can tell you from a BNY Mellon perspective, liquidity has always been a core part of what we do. So the bank was established in the middle 1800s as one of the first banks in the United States. It was in New York. Alexander Hamilton, he started it. And the primary purpose was to put the United States on the map as a financial market player. We BNY Mellon, we were created to provide correspondent banking, and it's what we've done since our outset. And as part of correspondent banking, liquidity is a key service for the financial institutions that hold accounts with us. Richard and I spoke to a number of bankers in Atlanta just yesterday about liquidity. And one of the core messages that we were sending was liquidity is about timing. It's about having money when you need it. And that's the service that BNY Mellon provides. So we do it in a number of ways. One of I'm going to talk about two key things from a BNY Mellon perspective strategically that are important for liquidity. The first was something that we put in place maybe about 5 years ago that related to big data. We have several lines of business across the institution. We support, just for wire transfer alone, we have 36 software applications that are vital to processing the payments. So when we look at liquidity, we have all these core software applications that are moving money back and forth. We had to get our arms around all this money moving. How do we know who's moving, what money, and when? So we created this big data repository, and we use that to track the liquidity of a client across lines of business. It gets every debit, every credit. It's a giant database. Has the time that the credit or debit posted, what the amount of the transaction was, who the client was, and we use that at an aggregate level to have insight into when a client is using liquidity and when a client needs liquidity. Now, throughout the bank, we also have tools that we can offer to clients to help them rationalize their use of liquidity. Does it make sense to be making these payments when you're making them? If you need to make these payments when you're making them, do we need to lend you money to get the payments out? That is part of our core liquidity services. And that is done at a cross line of business level, where there's a quarterback for the whole bank that says, hey, I'm going to look at liquidity across different lines of business to be able to rationalize where can we maximize the best value for the client. So that's the one of the key things I would say about this big data. And then the second thing, organizationally, we have the quarterback, and then within each line of business, there is a liquidity team that makes sure that they are in line with how the organization strategically is viewing that client from a liquidity standpoint. Let me stop, because that's liquidity.
Good. Richard.
So first, Carlos, I'll always appreciate the invitation to speak on your event and engage with your very knowledgeable audience. So thank you for the kind invitation. I will confess that on the subject of CBDC, I approach the question, and the clearinghouse approaches the question from a perspective of some skepticism. And I do suggest that, or will concede, that a CBDC may make eminent sense for select jurisdictions, may make a lot of sense for select use cases. But for the market with which I'm most familiar, that being the United States, I don't see a strong business case. And let me just sort of frame a few thoughts with respect to that skepticism and look forward to the engagement in the debate, because I know that encourages the best outcomes in the industry. But on that skepticism, I would just note first, we already have a digital currency in the United States, and it's called the dollar. There is nothing original in that statement. It has been expressed by many luminaries, including most recently, I believe, SEC Commissioner Gary Gensler. And it really underscores the obvious and the clear point that the dollar presently circulates widely and quite effectively in a digital form. I think that the principal feature that would ultimately differentiate a CBDC from existing digital forms of the dollar is that it would represent a direct liability of the central bank, just like a currency does presently. But I will suggest that deposit insurance of commercial bank deposits effectively serves, precisely the same purpose. So it's not at all clear to me, what the incremental value is of a CBDC adding to the value of the marketplace. And while the benefit, I will suggest is therefore quite illusory, I think the risks of a CBDC introduction are quite pronounced. I would highlight two, just to start. First, a disintermediation of the banking sector, reducing the availability and increasing the cost of credit. And I'll also suggest possibly exacerbating, financial stability risks during periods of stress, given the convertibility between commercial bank deposits and CBDC. I think you can take a look at the recent banking panic in the United States, which resulted in a mass exodus of deposits from small banks to too big to fail type institutions. Then contemplate if a CBDC, were in the marketplace, what the impact could be during a period of stress in terms of possibly exacerbating the liquidity conditions in the marketplace. I could go on, but I'll just pause right there. I approach this question with significant skepticism.
Good, and that's the idea, to discuss different opinions about this. But I'm going to focus on something which is not that related to the retail form of CBDC, but the idea is to discuss a little bit more about the wholesale CBDC. So it would be like, and that's like the second question, what is your concept of, what is your intuition of what a wholesale CBDC is?
So I will suggest that a wholesale CBDC with respect to the settlement, the transfer of value, really operates not much differently than a pure real-time gross settlement system. And therefore, from a liquidity perspective, is liquidity expensive? And I will suggest that the basic fundamental challenge with respect to liquidity savings is not necessarily solved by the introduction of a CBDC in which the settlement, would be not dissimilar to what already exists with present RTGS systems.
Stephen, what do you think?
So Richard and I talked about this. We were at the airport yesterday, and we had mentioned, hey, if we're both skeptical, then maybe it will be less interesting. So, but I also share Richard's points about the electronic nature of currencies today. So I think there is maybe some advantage to a wholesale CBDC, maybe if we think about it in terms. So if we think about currency in general, and this came up yesterday as well, if you look at the United States, when the United States started, it was a bunch of states, and each of the states issued their own currency. Now the currency was backed by metal, right? Gold was behind it, or you could have a silver certificate. And you theoretically could take your piece of paper, bring that to your bank, and you could redeem it. And you could get whatever silver or gold or underlying metal that you had for it. Now, the problem they had throughout the late 1700s and the 1800s is that the states had inconsistent regulation over the financial institutions that they were chartering. And as a result, those financial institutions sometimes were issuing paper for which they did not have the underlying metal to be able to be redeemed. So before the Civil War, in 1863, the United States put out the National Currency Act. We established the national currency, and it created the OCC, and it gave the United States national identity from a currency standpoint. There was a currency, you could exchange it, and it provided us with some firm standing over what that currency meant. Now, if we fast forward to, we had World War I, and after World War I, we had the Treaty of Versailles, which was really not very ecumenical for Germany, for example. And I think a lot of important state makers after World War II started saw that, and they said, look, the result of the Treaty of Versailles was that we created such economic instability that we caused World War II. That was because of us. So while World War II was still going on, all these world leaders came together and they created this Bretton Woods Treaty. I don't know if anybody heard, but it was a place in New Hampshire. Everybody got together and they said, look, we got to make currency common from a world standpoint. We need to be able to provide surety in the value of what you have. So Bretton Woods said, look, every currency in the world you can convert for some amount of dollars, and the dollars can be converted for gold, and you could stand behind it. The United States was there. We could give you gold for what currency you put in. That created
that was Dexter White against Keynes conversation, right?
There we go. See,
yeah. So
we've established this currency. That Bretton Woods was in place until the 70s, and into like 71 is when Bretton Woods we dissolved. Or 74 we dissolved Bretton Woods. And the gold standard was no longer relevant for the currency. So now that currency became a true fiat currency where we stand on the backing of a government that says this is the fiat currency. All right, so that was a lot of history about, well, what the heck does that have to do with the CBDC? Well, if you look at the CBDCs, that is an economic representation of the currency. It's still a fiat currency, right? It's still got the backing of a government behind it. And as Richard pointed out, when we calculate the money supply, right, the formula for, at least for the United States, is we've got M1, which is all the currency that's out there, and that's tiny. That's like 2.5% of the overall currency. M2, which is includes the deposits, is giant. That's your 96.5% of what your currency is. That's the electronic representation of what the bank has already today. So what's the value to a CBDC? I would argue it may be portability. Now, Richard had said, hey, if the CBDC is backed by the government and the government is the account holder of that, there could be some issue, and I agree with that. But if the government takes another avenue and says, look, we're going to create a digital currency, but we're not going to own it. What we're really doing is creating an electronic representation that becomes portable between account servicing institutions. It makes it easier from a corporate perspective to switch banks, maybe. I don't know how it would work, but theoretically, I could see some value in that.
Okay, okay, go, Richard.
So I'll elaborate on one or 2 points from what Stephen has shared, and always appreciate the dynamic. Carlos, you encouraged us to think about the wholesale angle of CBDC distinct from the retail angle, and I will posit that wholesale digital central bank money already exists today based upon the master accounts that central banks already maintain for their participants to settle interbank claims. It's not clear to me what a CBDC offers beyond the existing master account arrangements and existing RTGS systems that are already prevalent across the globe today. I think there is a technology conversation envisioning, running those master account deposits maybe through a new form of technology, such as digital ledger technology or distributed ledger technology. But it's not clear to me necessarily that changes anything fundamental with respect to wholesale bank payment activity. So I'll make that observation just to start. Go ahead, Carlos. Sorry.
That's where I wanted to go. If you ask someone from a central bank what is the difference between wholesale CBDC and the RTGS or the master accounts that they already have in place, we have to think about it. But if we start reading about what people expect from a wholesale CBDC, what they will have, it has to do with what you mentioned, that it could be run on DLT. That's one option, or that's one additional feature. The other one is to grant broader access, not only to banks in those countries in which banks are the only ones allowed to have master accounts, which is the case of the US, but it's not the case in Colombia. In Colombia, all financial institutions can access the master accounts at the central bank. So we could say that Central Bank of Colombia already has a wholesale CBDC in that account, in that sense. And the other one is programmability. So those are like the three things that perhaps, and I'm working like the devil's advocate because I know that Richard and you, Stephen, you are very skeptical about this. I am too, but I'm going to play the devil's advocate and try to find the way through the discussion. So otherwise, we'll have to end the broadcast here, and that's not the idea. We can get a lot from this. So if you allow me, let's assume that we have a wholesale CBDC defined in the terms that I just mentioned. It could have DLT technology or some other form of different distributed ledger technology. We could have the programmability, and we could have broader access to non-banking financial institutions. What could be the effect of these three things for a country like the US, for instance, if we would change the master accounts to this new form of wholesale CBDC?
So I think the question of access to having a master account at the central bank is really different than the wholesale CBDC question. I think that's an access question that really even goes beyond this conversation, Carlos, and would defer to our central bank colleagues to discuss the issues and challenges with respect to opening up access to non-commercial banks and institutions that are regulated in a far different manner than banks. I think that may be a separate question.
Yeah. So Carlos, I would say that's a very good, and I think it's a very good point that Richard's making here, is that the technology does not change the underlying purpose of what we're trying to achieve. So and then master accounts is a good example. The reason, well, the dynamic in the United States regarding access to the master accounts is directly related to that whole thing of the National Currency Act, where there are now national banks, but there's also state banks. And in order to get the access to the master account, there are specific requirements that the financial institutions needs to come under. Changing the technology of how that balance or the deposit is represented, I don't think changes the underlying hurdle that the institution would need to make. Does that make sense?
Yes, it does. And that's precisely part of the discussion. And I'm going to go a little bit more into the technology part, because as Richard, if I'm not wrong, you mentioned that if we are going to run, let's say, the master accounts, the registry of the master accounts on a DLT, most of the, let's say, interest in this type of blockchain or DLT thing is something that is this new buzzword of atomic settlement. And we already have seen, for instance, that there was a pilot in India in which the commercial banks using or participating in the pilot were complaining because this buzzword of atomic settlement was not very interesting to them, because unlike TCH, the atomic settlement means that everyone has to pay right away with the funds that they have. I mean, it's real-time gross settlement immediately. Let's call it like this. It's immediate payments at the end. But we all know that RTGS systems like TCH have liquidity saving mechanisms. And obviously that's in the benefit of the commercial banks and obviously of the economy, because saving liquidity, not having idle liquidity is good. It decreases the cost, it's more efficient. So from what perspective can we think that going to a DLT or a blockchain and having this atomic settlement is in fact going against the interests of efficiency and safety of the payment systems?
So Carlos, I'd go back to the observation that with respect to wholesale digital central bank money, it already exists today based upon the master account provisions that central banks offer to commercial banks for the ability to settle interbank claims. The prospect of a wholesale CBDC therefore strikes me as not that interesting or anything new because it exists presently. Now, there may be a conversation to be had in the future with respect to the technology supporting those accounts, and maybe a distributed ledger technology is a superior advance. And then there's also an access question that you've raised that I think is also relevant for discussion. But with respect to the introduction of a wholesale CBDC in and of itself, I don't think it changes much of the dynamic relative to what exists today. And the real revolutionary change is not therefore at the wholesale level. It's really at the retail level that raises all of the challenges, the objections, the concerns, some of which I alluded to in the intro, that I think are really more consequential from a policy and societal perspective.
Carlos, I'd just like to chime in on what Richard pointed out there, is that concept that of that atomic settlement doesn't have to happen for a CBDC. So I would argue that the experience that the Indian pilot banks had could have been changed had they, for example, engaged Chips and said, "Hey, Chips, we'd like to be able to try your algorithm using our CBDC and see if your liquidity savings mechanism could provide us with some benefits using our new technology for the representation of the balances." And maybe that would have changed things. I don't know that I think that merger of two types of technology is something that would be very interesting.
That's a very interesting point of view as well. So let's go to the other feature, which is programmability. Is this something new in the let's say space of wholesale payments?
Maybe I'll ask you to define programmability first, Carlos. What do you mean by the term? Just so that we level set with respect to the nomenclature here.
But that's spoiler alert. That's a spoiler alert already, because I wanted you to do it. But I would say that I mean, I haven't seen a definition of programmability out there that makes sense to everyone. But I would say that it's and there are even two forms of programmability. Are we talking about programmable money or programmable payments? Because it's not the same. So I'm thinking more in the sense of programmable money, in the sense of wholesale. And this is a conversation, for instance, that we had with the CEO of FNA, with Kimmo Soramaki, in the sense that programmability is at the end is the ability of money, in this case, to react to some conditions, to automatically react to some conditions. So what we were thinking at FNA is, what about, and I wanted to arrive to this, but you forced me to go from the end to the beginning, but that's fine, which is, what about if money is programmable? I mean, wholesale money is programmable, and as the liquidity conditions of the market change, the money itself learns or behaves in such a way that the payments or these payments in the system are optimized, like an orchestra, like a and reordering, orchestration of the payments, just because the payments, or there is some AI or machine learning or something that can tell, like a swarm of drones, like a swarm of sentient money, if you want, to decide by themselves where to go in each one at each point of time, to try to decrease the usage of liquidity, to make the usage of liquidity more efficient, just because the money is allowed to be programmed or to react to the different conditions of the economy. I'm talking too much, so I'm going to let you tell me if what we are thinking makes sense, at least.
Well, I appreciate your distinction between programmable money and programmable payments, and I think that's important to highlight. I will also just note in the evolution of payments, we have increasingly had more programmability features, such as standing instructions, bill pay, and I think what you're suggesting, may be a next wave of that programmability, if you will. And yes, I think there's likely to be more opportunity for that type of optimization with respect to payment activity and liquidity management going forward, given the new technology tools that collectively end users and banks and infrastructure operators are going to have at their disposal in the future.
So, Richard, in my mind, two things jump up. The first is, we had talked yesterday about the concept of the omnibus account that we use today for the liquidity savings mechanism chips. We have a separate omnibus account that's used for RTP settlements for those two networks that the clearinghouse supports. And the commingling of those funds in terms of being able to add liquidity for one mechanism or another. I think the concept, when we had talked about it, we were thinking about, well, over the weekend, when the Fedwire system is closed and you can't put money into your RTP omnibus account, what could you do? Well, maybe if we could create this type of programmable funds settlement, we can use the balance intelligently to say, oh, well, some of it's needed for chips. It's going to be needed for chips Sunday night, so I got to hold it aside. But I could commingle that entire pool so that I have enough liquidity to keep the engine running for real-time payments over the weekend. Maybe. So maybe you could use your intelligent balance for those types of mechanisms. The other concept that comes to mind for me is in circumstances where, as Carlos had pointed out before, where not every institution in the United States has access to a Federal Reserve account and therefore relies on a third party for access to some mechanisms. And in those circumstances, maybe there's a way to use the programmability of the balance to be able to move funds from correspondent accounts, potentially. Or in circumstances where, for example, maybe there's a CHIPS participant who has a number of third parties that are not CHIPS participants, but do have Fed master accounts, that they could somehow programmably move those funds during the day, maybe without having a treasury oversight person necessarily in place, or perhaps if we go in extended hours, we could do things over the weekend without having operational staff in place. Maybe.
That's very interesting. One point that I would like to raise, and it has to do with something that some of our attendants have asked, is at the end, there's also a lot of activity right now about tokenizing assets, tokenizing securities, tokenizing other type of assets. Does it make sense to have something like a wholesale CBDC, which is not account-based, but token-based, to better interact with other markets that could be already tokenized, like securities or so?
Steve, do you have a view on that? I confess,
So- I will throw this out. So what I had talked about earlier was about that, why bother with the whole CBDC concept? And maybe it's about the portability of the deposit. So where the central bank is going to identify the deposit as being owned by a particular corporate, it'll have that electronic representation of it, but the central bank will not be responsible for the deposit. The deposit will be the account servicer, the account institution, the financial institution is going to own that. The representation, however, makes it simpler for the corporate to move it from financial institution to financial institution. Now, in my mind, I was thinking about in the United States, but Carlos, you make an excellent point. What if that portability could be extended outside of jurisdictions? So the US government says this is an electronic representation of a deposit for a particular corporate. And the Bank of England says we accept that representation on our own mechanism. We will allow that corporate to port the balance from a US financial institution to an English financial institution or a British financial institution. Or maybe we go to China and we can move that balance to a Chinese institution simply through jurisdictional agreements about the representation of that electronic deposit.
That
So
sounds like RLN, right? Like the regulated liability network that we have heard a little bit about in the last months. That sounds more like it, Stephen, right?
It is a very similar model in terms of the agreement between the central banks about that representation. But I think, Carlos, your extension of it would be not just that it's the central banks agreeing about the representation, but that it belongs to that corporate.
Richard.
So in transitioning to the discussion of portability and using an example of a corporate, I will suggest that we've morphed a little bit, from the consideration of a wholesale CBDC to a retail CBDC. And we'll also suggest that the practical challenges of introducing a retail CBDC, I think, have been vastly underestimated. And I will note, number one, that direct distribution by central banks to corporates or to consumers, I view as probably out of the question given the KYC, AML, BSA concerns, and that decentralized distribution through the banking system, as some have suggested, would require a huge infrastructure investment by commercial banks to support, on top of the demands that have already been placed on them with respect to ISO and the establishment of instant payment rails and the like, to support a vehicle that competes with their own commercial bank money, if you will. So I think the distribution challenge is a significant one, especially when the concept of a retail CBDC is introduced into the discussion.
Yeah, I agree. And sometimes, I mean, in discussions about wholesale and retail CBDC, one very obvious question arises. Why do we need to have the distinction? I mean, why not having just a CBDC that works wholesale and retail? And that's it.
So I completely agree. So Richard, I completely agree that I don't know that there needs to be a distinction between wholesale and retail, especially if the benefits of it are related to the portability. That retail concept, I know that they had talked about, well, we can now bank the unbanked, but at least in the United States, I would argue if a person doesn't have a bank account, it's because they don't trust banks. And if they don't trust banks, I'm pretty sure they don't trust the government much either. So, I don't know that would then definitely going to be an uplift in the unbanked. I understand the argument, but But Richard, to your distribution model, one of the things that jumped to my mind right away, I have not worked, and I've worked at a number of financial institutions. I have not worked at a financial institution where the underlying core DD platform was younger than 25 years. That source technology that we keep track of our accounting systems, and for good reason. I mean, it works like a clock. It doesn't go down. It does what it's supposed to do. But if this technology provides some capability for an easy technological uplift, it would be worth looking into. To be fair, it may not be easy, and maybe it would be a lot of work on top of ISO and everything else we're going to do. But it's an interesting concept to think about.
I agree, and I think that at the end, the whole topic is about how these three main defining features of a wholesale CBDC could make a difference to a jurisdiction. And I agree with something that Richard mentioned at the beginning. For the US, perhaps it doesn't make sense to have a wholesale CBDC or even a retail CBDC, but for some other jurisdictions, it may make sense. So that's also very, very important to highlight here. So one other question from the audience, and I'm already jumping to the question from the audience, is there an advantage of having a wholesale CBDC in a token-based form? It's similar to what I already asked, but is there any advantage besides portability, which is what Stephen has been very you have emphasized a lot?
I mean, the only other thing that comes to my mind is potential fraud mitigation. So the advantage of the token on top of the representation of the deposit is that it provides some anonymity to the underlying specific account details. In outside the United States, it may have less value than in the United States, where checks are still predominant, and there is the capability for you to fake a check by using somebody's account number. Potentially within ACH networks as well. So I guess maybe even in Europe and where we have other ACH systems, the tokenization would at least protect the account number identification for the use of the traditional payment mechanisms.
But then I would say that for wholesale, I mean, for payments among banks, tokenization, it's not very clear what it could bring. I mean, what advantages can we get from tokenization of wholesale payments?
No, I'm making the argument that by using a token, you hide the underlying account number, and the underlying account number is not exposed. So the bad threat actors don't see it. And just using the token is not enough to be able to access the account. You know, if you need the account number as well to access it, you can prevent fraud through the use of a token. Now, I am certain I'm not a very good bad guy, so I'm sure that there are bad guys who are able to figure out how to use token to be able to get access to funds. But at least to my mind, that there might maybe some benefit from a fraud mitigation.
That fraud mitigation angle, though, would apply to retail rails predominantly, not necessarily wholesale CBDC, which I think is Carlos's point. So I think that the tokenization interest is largely affiliated with more retail channels.
It might be where my experience has been related to what I was thinking was circumstances where the account number of a corporate client had been exposed and then used to move funds without the corporate's knowledge. It's similar to the retail exposure. I think the advantage to many corporates is that they have a much closer eye on the movement of funds. So it's I think a little bit easier for them to be able to keep track of where money's moving. But that was the example that I was thinking of.
Good. Richard, Stephen, thank you very much. I'm going to now jump 100% to questions from the audience, and perhaps one of the questions that I have seen here. Let me check. How can the correspondent banking system be affected if the wholesale CBDC allows non-commercial banks to have accounts at master bank accounts at the central bank? I think it's a question about the tiered system that we have in most RTGS systems around the world, right? That only commercial banks are allowed to access, so other financial institutions have to access through those commercial banks. If the feature of wholesale CBDC, or if one of the defining features is broadening the access to non-banking financial institutions, will this have implications to the correspondent banking model that we have today in many countries?
It would reduce the barrier to entry for a non-financial institution to participate in a correspondent banking-like service. So, Carlos, I make the argument often, and I know Richard's heard this. As a bank, we have two core competencies, and this is it. Trust, right? Our clients trust us to be able to do stuff with their money and lend them and to do what we say we're going to do. And we have a network. We know banks that you don't know. We're able to move money on your behalf because we have a great network of who we know. And those two things are not technology related. Those are related to what we do for a living because we've been doing it for 200 plus years. So I think even if we reduce the technological barrier or the regulatory barrier for a non-traditional entrant into correspondent banking, I don't know that it's drastically going to change the scene, if that makes sense.
Richard, anything to add there? Or?
Richard, did that actually make sense, Richard, or is that because?
No, I think it did. I think it's a larger question, however, with respect to whether a central bank would allow a entity other than a commercial bank to hold a CBDC as a direct liability of the central bank on the central bank's books. I think that's a question that has profound policy implications, and I haven't heard anything from our central bank suggesting that it's entertaining such a consequential policy leap.
I think Carlos, that goes right to the point before that Richard was talking about, where regardless of what technology we come up with, the underlying regulatory burden doesn't really change.
That's true, and this goes exactly to a saying that we can coin already in the FMI broadcast, which I don't remember who said it now, but it says that all the problems are 10% technology, 90% regulation, coordination, and so on and so forth. So perhaps that's not the issue here. I mean, to have programmability, DLT, so on and so forth is not really what is going to change the thing. It's perhaps more from a central bank perspective, as Richard has mentioned twice. It's more like a decision of the central bank to grant that access. It's not a matter of the technology at the end. So we're finishing the broadcast. So I have a final comment, which is very interesting, and I would like to close with it, and which is, please do not classify financial market infrastructures as plumbing. A CCP is not a pipe and faucet, and I think that we can say that TCH is not a pipe and faucet, but I can see that Stephen and Richard, you both like history. Who said, or who is the claim to be the first one to say that financial market infrastructure is like the plumbing of the financial system? As far as I remember, if you have it, you let me know.
I do recall a former president of the Federal Reserve Bank of New York, President Corrigan, referred to FMIs as sophisticated financial plumbers, but I'm not sure that's the first reference, Carlos, but it's one that lingers in my consciousness.
in my head, from the top of my head, if I'm not wrong, the 14th chairman of the Federal Reserve, Ben Bernanke, was the one I read the first using that term in a paper. And I think it's beautiful, not because plumbing is awful or I think that plumbing is not something to take lightly, because you know that FNA we like to talk about networks a lot, and I think this is like the second layer network beneath the financial institutions. And if that second layer network that normally is hidden below everything, if it doesn't work well, banks cannot work well. And that's the center of what TCH does at the end. And that's why banks as BNY Mellon care about how the financial market infrastructures work and how to participate and to interconnect with financial market infrastructures. So I just wanted to say that my usage, because it was me who said the FMIs are as plumbing, is not a pejorative way of talking about FMIs, but highlighting that if it doesn't work, you cannot move to that house. You cannot live in that house at the end.
Plumbing is essential, Carlos.
I agree.
Yes, having just visited Greece, plumbing is vital. If you haven't been to Greece, you don't know what I'm talking about, but those who have visited, plumbing is essential. Good plumbing.
That's great. Stephen, Richard, thank you very much. This was a very interesting and enjoyable conversation. I know that we had some technical glitches at the beginning, so sorry for this. But I think that the contents of the conversation, as usual with you both, are very interesting, because we have a lot to discuss about having eclectic and skeptical point of view about the new solutions that are coming our way. So this is always very interesting. That's why it's always very interesting to have you both here. So thank you very much once again, Richard and Stephen, for joining us. Thank you everyone for joining us. This is the end of FMI broadcast number 11. If you want to get in touch with Richard, Stephen, or with myself, on the webinar chat, you can find our contacts, the links to our LinkedIn profiles. So please drop us an email or a message if you need so. Please remember that we have in August, we have other broadcasts from FNA involving Payments Canada, MTech, BIS, the Central Bank of Lithuania. And also remember that during 2023, November 16 to 17, we have the Clearinghouse, the TCH Annual Conference 2023. If you want to register, you'll have the link in the presentation that we're going to distribute among you. So again, thank you everyone for joining. This was very entertaining and illustrative, obviously, as usual.
Always a pleasure, Carlos.
Thanks, Carlos. Thank you, Richard.
Thank you, Steve.
Bye.